From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Welcome to another episode of the Macrocast. I'm your host, Bryan DeAngelis, a partner here at Penta, joined as always by Brendan Walsh and John Fagan from Markets Policy Partners, as well as my colleague, Ylan Mui, a managing director here at Penta. Thank you all for joining on, I think, what's going to be a pretty action-packed episode of the Macrocast. This week, we're going to talk Fed jobs report, which we just got about a half an hour ago. We're also going to dive into Fed Chair Powell's testimony up on the Hill, as well as the news kind of breaking on Silicon Valley Bank. We were joking before the show started. It's always exciting when there's breaking market-moving news as we're recording. So we'll do our best as we record this at 9:15 a.m. To make it still relevant when it's 4 p.m. and gets released. But let's jump right into it. Ylan, I'll turn to you if you don't mind. Break down what we saw. Pretty strong jobs report once again for February.
Yeah, I think everyone had been waiting for this jobs report to understand what the trajectory of the labor market is going to be and what the trajectory of future Fed rate hikes might potentially be. January had a blockbuster number, over 500,000. February's number was not as big, which might be a relief to some investors and a relief to the markets. But the bottom line is it still showed that the labor market remains strong despite the level of Fed tightening we've seen so far. So the economy added 311 jobs in February. That was beating market expectations of about 225,000 jobs. The unemployment rate, that did tick up to 3.6% compared to 3.4% the previous month. But a lot of that was from people who were either entering the labor market or stayed in the labor market after losing their jobs. So the bottom line is that the size of the labor force grew. The labor force participation rate edged up to 62.5%. We saw 419,000 people joining the labor force in the month of February. So those are all really strong numbers. The other important thing to note was that the hiring was pretty broad-based throughout the economy. We saw big gains in the retail sector, in healthcare, even in local government. Where we saw the declines were kind of where we expected to see them, which was in the information and technology sector that shed jobs, as well as in transportation and warehousing, as I assume many people like myself are no longer doom scrolling on Amazon and just buying things in the middle of the night and having them shipped directly to their house as soon as possible. So those were perhaps some sectors that we expected to see some weakness in, but there was strong hiring kind of across other industries. Two other points to mention is that we did see an increase in average hourly earnings. Those were up 4.6% year over year. That is higher than they were in the previous month, but it is a significant slowdown from the 5% plus gains that we saw throughout 2022. And that might be a, perhaps optimistic sign for the Fed that there is some cooling off in terms of wages. And we're not going to get into this sort of wage price spiral that defined previous periods of inflation. And then finally, just to pay attention to is the revisions of previous months' data. Nominally, they were down directionally in the right direction. So December jobs number was revised downward by 21,000 jobs. January's number was revised downward by a mere 13,000 jobs. So again, the arrows are pointing in the right way. But overall, there was a 34,000 job revision to the downside for the previous 2 months. So perhaps there's some signs that, we're no longer at a roiling boil of the labor market, but certainly things are still pretty hot.
Still hot, but just simmering. Yeah.
Yeah, the knee-jerk reaction in the markets was, just as you say, Ylan, focused on the underlying details. When that first headline number crossed the tape, there was a bit of a, another, flashback to the January number coming out so hot, which, as we all remember, was a real challenge for equities. They retreated and Treasuries sold off hard. That initial reaction was really balanced out as apparently as people got into the details and, as you say, focused on that average hourly earnings which is, the 0.2% month on month was a much more mellow pace than we've seen previously. And the unemployment rate ticking up from 3.4 to 3.6 provided that, it's a little strong to say it's Goldilocks, not too hot, not too cold, because this is still pretty hot. But it balanced it out, and markets digested it. As we've gone forward, there are a lot of other headlines. We'll talk about that. So it's hard to kind of isolate the impact of how this would play through in the absence of other catalysts. But, the reaction, at least initially, was pretty favorable from financial markets.
Yeah, so no real huge surprises in the details. I mean, we're still seeing the service sector be hot, and as Ylan mentioned, the kind of info tech and transportation dropped down a little bit, as I think we talked about last week with John Dick and others. But I'm curious to go a little deep in, Ylan. I know you've been looking into this. Like, what is the demographic looking like now for the labor market? We've seen a lot about, especially women, left the labor market in huge numbers as COVID hit and we went into quarantine and, school shut down, et cetera. We're starting to see, I think, some strong numbers of women returning back to the workforce. But what are you kind of seeing in your research there?
Yeah, there are some really encouraging signs here. So I mentioned that the labor force in the month of February increased by 419,000 workers. More than half of that, 279,000 of those people, were women. We also saw that the unemployment rate for women is lower than the unemployment rate for men. It did go up last month, but that's because there were so many more people who are looking for work, and that's a good sign. So we are coming out of what was known during the pandemic as the she-cession, when there were 10 million men who lost their jobs, but 12 million women who became unemployed during that time, because the pandemic really hit a lot of those service sectors that disproportionately employ women. Again, we think about retail, we think about leisure and hospitality. Those are the very sectors where we're seeing some of the biggest job gains today. So we're seeing a lot of women come back into the workforce. And in fact, the number of mothers who are in the workforce now actually exceeds the number who were in the workforce pre-pandemic. That's according to a recent Wall Street Journal story this week. And so I think that is a very positive dynamic and a great thing for those people who are in those jobs. And it's a sign that when we have a strong labor market, that it can really pull people off of the sidelines and back into the workforce and get them back in jobs, earning money and contributing to their families. The downside of that, though, is that it's coming at the price of prices, right? It's coming at the price of higher prices and a higher cost of living. And that's the tricky dynamic that the Fed faces. We saw some of that tension on display during Fed Chair Powell's testimony on Capitol Hill, where he really got hit on both sides of the aisle in how many jobs are you willing to sacrifice in order to rein in inflation? Because there are real people who are in those positions, and there are real people who could be affected, many of them women and people of color.
And very interesting. So with what the Fed's doing is a huge issue for going back to the labor force for women has been childcare. Childcare costs were so high that a lot of women stayed home because it just doesn't make sense to go back to work. Raising rates to put people out of work isn't necessarily going to help the labor force in terms of childcare. So women need someone to watch their kids to go back to work, but putting us in a recession isn't necessarily going to help that. So there's an interesting dynamic for the Fed on that front.
Yeah, and there was a similar interesting point in that Wall Street Journal piece that, if or when we head into a recession, depending on where you stand, that's probably going to hit sectors of the economy that are a little more male dominated. So how much of this is also, women looking forward and saying, I've got to get back into the workforce because my partner, my husband may be out of a job in 6 months. And, now that, again, kind of to Ylan's point, wages are going higher and higher, it's getting more and more attractive to go do that and figure out the childcare, even if it's, a limited market with a more expensive childcare cost.
Right. But to your point, Brendan, I mean, there are structural problems in the economy that rising rates may not be able to fix, right?
Yeah. Especially with that really, Capitol Hill needs to address that. It's not something that the Fed necessarily can fix.
Yeah, and you saw Biden try to do that a little bit with the budget this week, but we'll get into that some more. Let's talk a little bit about Powell. I mean, he was up on the Hill for his testimony in front of both House Financial Services and the Senate. Kind of an interesting couple of days where he sort of, spooked some interest in maybe a double-digit hike, a 0.5 hike coming next, and then sort of like try to walk that back the next day of it'll be driven by the data. I mean, any of you guys, what is he looking at in today's data that's maybe making him think half a point versus quarter point for the next time?
I think to some extent today's data is a little bit of a Rorschach test, right? You can cherry pick whatever you'd like. If you wanted to use this big headline number to justify going back to 50 basis points at the March meeting, you can do that. If you wanted to point to the cooler average hourly earnings or the unemployment rate ticking up or some of the other details in there, you can do that. But, so much of what they're going to be doing is dependent on what CPI and PPI, the consumer price and producer price index figures are next week. That's really going to be where the rubber meets the road, we think. And so Powell
today's
really
kind of their last opportunity to talk about that, because they go into the blackout period before they won't be able to talk once the CPI comes out.
Yeah, it's a little bit. We have you don't want to beat up on the Fed too badly. They've got a really tough job, but we're our own kind of view. And I talked this over with Ylan yesterday. Is really, at this point in the tightening cycle, do you really want to be in reactive, like data dependence mode? You've got, you're practically like 500 basis points into the tightening cycle. You should have like a firmer hand on the tiller, a little bit more of a longer view, rather than chasing, a data point here and there and have, they've obviously gotten blown off course by this January, this hot January data. And, the Chair Powell had, as you said, Ryan, he sort of veered between, Ylan said it yesterday, coming in hot. He came in hot on the Tuesday and then tried to maybe walk it back, hiding behind data dependence. But now there are other factors in the mix in the banking sector that we'll talk about that clearly are having an impact on the way that investors are looking at these rate hike odds. The 2-year Treasury yield has come down. It plunged 20 basis points yesterday. It's down like almost another 20 this morning. That is an enormous move at the front end, and that's all driven by the idea that the Fed is going to have a real tough time regaining its like most aggressive posture in the face of some of the challenges that the banking sector or parts of the banking sector are facing.
While we report about the 10-year, because that's what mortgages are based off, the 2-year really has been the most predictive, or not necessarily predictive, but shows really what the Fed is doing. I think that's been the one to follow in the last year or two.
Can I ask a question here, if that's okay?
Yeah, please.
I'm curious whether you guys think that a 50 basis point versus a 25 basis point rate hike really makes a difference in terms of the impact on inflation or in terms of the ripple through effects in the economy? Or is it really more about the signal that the Fed would be sending that it's now willing to be a little more aggressive than it had been, and that it maybe now feels that the control of the yield curve is falling away? Is it the number that matters, or is it the signal?
I think it's the signal. My view is it is the signal, and the signal would be not just that the Fed is getting more aggressive, but that the Fed was wrong. And he was talking about disinflation as recently as a month ago, and they'd settled to 25 basis points, and they were kind of in the set it and forget it mode, looking at peak rates coming sometime pretty soon, and now they're back at 50. That just is, it shows that that their credibility, I think, would suffer a little bit from that. Aside from just the surface level, increased aggression and how the Fed, how the markets would have to price that in.
Yeah, it's certainly a good point. I mean, I think even with all the telegraphing in the world, it'll be quite a shock if they go back up to 50 points. There's a lot of threads here. I want to connect to what we're seeing on the big banks yesterday and some of the drop they saw, as well as obviously this issue around Silicon Valley Bank. But let's take a quick break. We'll come back. We'll dive into that a bit more. Maybe touch on some of the debt ceiling talk we saw from Powell as well, and jump into all of that stuff. So we'll be right back on the Macrocast.
On the first Friday of every month, Penta analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at pentagroup.co or on Twitter at pentagrp.
We're back on the Macrocast. Going to jump into some breaking news really happening over the past 2 days, and especially kind of heating up this morning. Brendan, I'm going to ask you to kind of back us up and walk through a little bit what's happening. But Silicon Valley Bank, right now has kind of frozen. They're trading, looking either for a seller or a huge capital deposit. Like, they're obviously in some trouble. Walk us through kind of what happened here and what we might expect in the next, I guess, hours, not even days.
Yeah. So honestly, we're finding out by the minute exactly what's happening. But certainly the collapse of Signature Bank, which was a crypto bank, kind of got this all going. And Silicon Valley Bank is a unique bank. They're based in San Francisco, and their clients are very much, tech startups, and they bank you, and then they also make loans to you. And a lot of times they take equity in your fund. So this isn't just a crypto thing. It's also kind of the tech sector is not doing quite so well as it was a couple of years ago.
Yeah, this is startups and VC
and we haven't had an IPO. So where they make your money is, they fund you in your startups, and then you go public, and then they make a decent amount of money. So their balance sheet is a lot more risky than your average bank in times of stress. In good times, they do quite well. It was one of the high flying banks for the last 10 years. But also now that we're digging under the hood a little bit, it's also clear that they have very weak deposits. So if you get a check and you have automatic deposit into Bank of America, you're a high quality.
You're funding the
deposit.
Bank, right?
We know that every month that your deposit's coming in. They have a lot of brokered deposits, things that come in and out, and actually a huge amount are not FDIC insured. So that always raises the chance of a bank run, because you're really just there for the yield. You're not necessarily there for doing banking with them. They also, the Federal Reserve and regulators require you to hold a certain amount of assets. Yeah, and it's becoming clear that they don't quite have the high quality assets, with basically treasuries that your average bank does. So there's fears that that they might go under. So the news just came out that they're actually looking to sell themselves.
Yeah, can you break the treasuries point down for me? I think I understand it, but for our audience, I mean, basically they've been holding treasuries, and now there's much more lucrative treasuries out there. So they're selling at a huge loss?
Yes. So it's called mark to market, where as a bank, usually you don't have to sell. So, if you bought a treasury that is yielding 2%, you can hold it. And the fact that technically that treasury price has gone down because yields have gone up, you don't have to mark that, because a bank very rarely ever has to sell. They now actually have to sell. So they're selling their treasuries at a big loss because rates have gone up. So when rates go up, the price of a bond goes down. And that's what they're dealing with now, where they're actually having to sell their high quality assets, which are treasuries, for a loss from what they had it booked on their balance sheet.
Yeah, the data that they discussed yesterday was that they sold almost all of their available for sale securities, and that was essentially around 21 billion for a loss of 1.8 billion. So they realized that loss. That is a really challenging thing. And then
a lot of the other stuff that they held, because they were a unique bank, was like equity in these companies. So it's very, very risky stuff.
Yeah.
And so the announcement yesterday was that they were going to be raising 2.25 billion, very dilutive capital raise. So 1.25 billion in common stock, 500 million in mandatory convertible preferred, and 500 million in common stock private placement. That was, obviously designed to try to stop the bleeding, but it wasn't particularly encouraging. It's come out this morning that they've struggled to get that taken care of, and so it looks as though they're going to have to go a different route, sell themselves, et cetera.
Yeah, and this is also bleeding to other banks of similar, like First Republic Bank. So Silicon Valley. And
this
First
is what
Republic
I wanted to ask. I mean,
they were two of literally the best banks in America. They were touted as the model of what you should do, and it's also interesting. So when rates go up, so also, I don't know if you've noticed your yield on your deposit. Banks have not raised what they're paying you on deposits as much as they've raised what they're charging you on their loans. So this is supposed to be a perfect scenario for a bank. They're supposed to be printing money. But unfortunately, it hasn't happened in that way. They haven't been able to make loans. And then it seems like a lot of their balance sheets weren't quite as strong as we had hoped.
Yeah,
the question really is Silicon Valley Bank and some of the other banks that are sort of implicated in this, are they just such different creatures, right? That this is really not a problem that is going to be coming soon to the Midwestern banks that lend to more agricultural industrial clients. Is this, and obviously the larger banks have been insulated to a great degree because of the diversification of their deposits and their capital structures. So there's certainly like the more bullish, the more positive spin on this is very isolated. This is an isolated kind of incident. But when it comes to banks, you always have to take this sort of thing very seriously. You can get that, pro-cyclical kind of dynamic through the small, medium-sized and regional banks and that sort of thing. And once some of the selling picks up momentum, it can be hard to stop.
Yeah, I mean, this is a classic bank run. We're seeing it in real time. Like what happened back in the 20s, and this is happening to Silicon Valley, and then that fear. We're not seeing bank runs in the Bank of the Ozarks or First Republic, but we're seeing bank runs in terms of equity investors fleeing those stocks. Yeah,
and as the public affairs guy on the pod, I can't help but point out, there were some stumbles. We just have to call it what it was. I mean, the CEO, they put out their press release about this capital raise when Silvergate news was breaking, which was not great timing. The CEO had to jump on a Zoom call and say, "Don't panic," which I saw one writer this morning compared it to that last scene in Animal House where you're yelling,
"All is
"Don't
well."
panic." And that just, it's a confidence thing that causes that bank run. But John, to your point, I am curious. I never assume they're alone, but they are a very different bank. We did see the four kind of biggest U.S. banks took a big loss. I think it was 50+ billion yesterday in market value. That's obviously somewhat connected, but I don't think there's really a risk here, a contagion risk or any big issue like that. Or are you guys seeing anything differently?
Well, it does get wrapped up into this whole idea of, if the banks are, if the bodies are floating to the surface, there's a lot of sensitivity in financial markets about this kind of time in the Fed tightening cycle. You'll get all this commentary from the old market hands, something always breaks, right? At this point in the something always, maybe this is it. And you've got, Michael Burry and the big short crowd coming out and filling, the airwaves with dire predictions and the doomsayers and that sort of stuff. And so it can, and let's face it. I mean, despite the fact that we had January data coming in really hot, the base case for a lot of investors and a lot of economists is we are going to have a recession in the back half of this year. And if problems are already showing up in the banking system now, is this a harbinger of hard times to come? That's certainly, the deeply inverted yield curve is flashing a warning signal, has been for a long time, and we're all hoping this time is different. Maybe the yield curve is wrong, but it's coming at a nervous time in financial markets, at a time when what's the Fed's reaction function going to be if they're fighting inflation on one hand, but they're trying to make sure that the banking system doesn't experience, the volatility that the Fed's sort of swerves have induced in the Treasury market. That's not good for the banks.
Yeah.
And this is interesting because the Fed is both. They're the one that is fighting inflation, but they're also the regulator of these banks.
So that's actually where I kind of wanted to wrap the conversation. I mean, obviously the Fed is the regulator here, but the Fed is also intentionally and strategically, causing this pain. And this is a little bit of a result of the work they're doing. So, John, what do we make of this? How do we think Powell processes this or thinks about it as he heads into the next meeting?
Yeah, I think Powell and the Fed have to go back to more of a do no harm posture, right? At this point in the tightening cycle, we've got a lot of interest rate hikes behind them, and this sort of the flagged return to 50 basis points tightening increments, maybe that they should stick that in their back pocket, go back to 25, a more measured cadence, talk about, its policy is also, verbal so much for the Fed, of course, and talking about how, we're watching what's happening you don't have to ring an alarm bell. You just have to say, we're watching what's going on in the banking sector. And, we realize that there are issues there that we have to keep an eye on and might have consequences for policy. The markets are already getting ahead of this. We're seeing the front end of the Treasury curve just screaming lower. It's down, I think, 25, the 2 years down 25 basis points this morning after 20 yesterday. So the market's already getting ahead of this, where the Fed has to get back into, more of a balanced kind of posture and watch both flanks rather than just having single-minded, approach to attacking inflation.
But I would say, on the Fed's bingo cards, they did not think a mini banking crisis was going to happen. So this has to be, kind of spooking them, not a little bit, but a lot. Today, with the jobs number, normally Powell would be being briefed by his economist, but I think Michael Barr is the one that is taking up all of his time, who is the head of the supervision.
Yeah, and still, obviously, a lot to come. We're sitting here at 10 a.m. We'll try to get this episode out quickly, but we'll see.
But also, I think, someone will probably buy Silicon Valley Bank, for pennies on the dollar, but I don't think this is a systemic issue. I think that our banking sector, what we did after 9/11, you were part of it with Dodd-Frank. We might have overdone it on times, but what the big thing that we did in Dodd-Frank was tell banks to hold more capital.
Yeah, right.
And capital works in times of stress. And we're seeing that, Silicon Valley didn't quite have the strong capital that, a SIFI does, but no one's particularly talking about Bank of America going on under today,
No, and it's because of that pretty robust capital requirements, and so we should be in a good spot there. All right, let's obviously more to come, but let's leave it there. Brendan, anything we're looking out for next week? I know we got the couple big ones, right?
Well, the CPI will be the huge data point of next week, and we've had some estimates from various Fed regional Fed banks raising their estimates for inflation for this year. So where we 2 months ago we really were in consensus that we're in deflationary time. We're not quite as sure as we were 2 months ago.
All right. Well, it'll be a good one. I think it's a St. Patrick's Day Macrocast next week. So, Brendan, you bring the Guinness, and we'll have our show.
It's a combination of my two favorite days of the year: St. Patrick's Day and also the start of the NCAA tournament. So
that's right. Yeah. So we'll do our best next week. Yeah. No promises.
We film it early enough that we'll do a good job on it. But if we filmed it later in the day, it wouldn't be quite as
Yeah.
Enlightening.
All right. Well, we'll call it there. Thank you to all our listeners for tuning in to another edition of the Macrocast. I'm Bryan DeAngelis. As always, special thank you to Ylan, John, and Brendan for joining me for another episode. Remember to like and subscribe wherever you listen to your podcasts, and have a great weekend, everyone. We'll be back next week.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.